The Fed just cut rates by 25 basis points, marking their third cut this year. But if you're wondering why mortgage rates didn't fall dramatically, it's because mortgages don't follow the Fed funds rate directly. Mortgage rates are driven by long term bond markets, inflation expectations, and the labor market. And this Fed decision revealed meaningful internal disagreement. Some members want a much larger cut, while others want a no cut at all. That tells us the Fed isn't fully convinced inflation is behind us yet. Now let's look at now let's talk about jobs because this is where mortgage rates really take their cues. While job openings have ticked higher recently, they may remain well below 2022 levels. More importantly, hiring rates, quit rates, and layoffs all point to a labor market that is gradually cooling. We're also seeing delayed labor data released this week, which may be incomplete due to prior disruptions in the reporting. Even so, the broader trends suggest unemployment could edge slightly higher as economic momentum slows. When the job market cools, wage pressures ease, inflation pressures come down. And that's what eventually leads to lower mortgage rates. That process isn't immediate and it's rarely smoothing, which is why we're seeing volatility instead of a straight line linear path down. Overall, this type of data tends to be bond friendly, which is good for consumer mortgage rates over time, but not overnight. What this means is if you're buying or refinancing, waiting for the perfect time for rates often costs more than structuring the deal correctly today and hoping for a refinance down the road. Seller credits, temporary rate buy downs, and refinance planning can put you in a strong position now while preserving flexibility for later. And for homeowners considering a refinance now, knowing your strike rate and having a strategy in place ahead of time can make a lot of sense. And that's where I come in. A recent Q3 report from Cotality shows average homeowners' equity around $300,000 in their home. This is driven by appreciation and amortization combo. That tappable equity can be used strategically to improve your cash flow, consolidate higher interest rate debt, or fund investments depending on your goals. If you want help thinking through the right strategy for your specific family financial situation, I am happy to walk through it with you.